Right, welcome everybody. We're delighted to be joined today by Simm, the founder and CEO of Impax Asset Management, and by Charlie Ridge, the CFO. And they're both here to talk about what appear to be a very impressive set of full year results and to give us hopefully a few hints about what the future holds for Ian. And Ian, you used the phrase in your release today, a landmark year. Perhaps you might want to pull out one or two of the highlights that led you to say that.
Yeah, sure. The year to the 30th of September 2018 has been a great year. So in that time period, we've increased our assets under management by 72%, reaching £12.5 billion, which is the largest assets under management level we've ever achieved. Behind that's been a number of things. So we've had very good investment performance. We've been able to attract almost £1.5 billion of net new money, which continues the very strong level of net inflows from 2017. And we've also been able to close the acquisition of Pax World Management, which was completed.
Transformational, to use another word that was used at the time.
Yes, so that's a business that adds considerably to our US footprint and also provides a nice diversified source of revenue from different types of products. So yes, it's been a great year.
Mm-hmm. And you talked a little bit about the performance of the funds. You were a fund manager, and I think increasingly in volatile markets at the moment, the reassuring thing, at least to me as an external observer of the results, was that your underlying funds and the assets that you are investing in your pursuit of the sustainable environment have been performing extremely well.
Yes, in particular our global opportunity strategy, which we seeded in late 2014 and really provides the broadest exposure to our investment theme around the transition to a more sustainable global economy, has significantly outperformed the market this year, and that's been at the heart of some quite significant client wins. We took on board just a couple of days ago actually the money from St James's Place, who've hired us to run their sustainable and responsible investment fund, so that's £280 million of additional money that's landed in December. Our private equity strategy has also been performing extremely well, so we've almost completed the exits from Fund 2, and that paid out a decent amount of carried interest in the summer. That was behind our special dividend of 2.6 pence per share, and that performance has underpinned the successful fundraising for Fund 3.
Mm-hmm. And when you're competing to manage external assets, is it more a case of you having to show that within the sustainable investment environment you have the best track record, the greatest resources, or is it a case that you're actually championing the cause for sustainable investment itself, so that it's very much a top-down decision by those asset allocators to gain more exposure?
Well, I think in the general economy there is concern about rates of global growth over the next 3 to 7 years, and in that environment there is strong interest amongst pension fund managers and private client managers for information and access to markets that are growing rapidly, expanding almost in spite of economic doldrums. And there's strong evidence that the environmental and sustainable development sector, where we're dedicated, is showing those characteristics. So markets for renewable energy, for water supply and treatment, for recycling, for the supply of sustainable food and agriculture products are growing very, very strongly.
Which at this particular juncture, where there is considerable uncertainty about the growth in global GDP, free trade, which is translating itself to equity market volatility, it must be a distinct advantage to have a strong tailwind pushing the sector in which you have the expertise.
Yes, that's very much the case. There's another factor as well, which is that around the world there's an increasing number of owners of private capital as well as institutions that are wanting to see their money deployed in such a way that it doesn't do any harm to the planet, or ideally has some positive impact on the planet. And most of the strategies that Impax Asset Management are running do have very strong positive environmental footprints. So although we don't set out to create a positive environmental footprint, our objective is to make great risk-adjusted returns, we do have some pretty compelling data around those environmental characteristics.
And you mentioned the deployment of capital. Presumably that is also the other side of the coin, as it were, that as publicly listed valuations are coming down at the moment, presumably in terms of some of the target investments that you would like to do, valuation is starting to appear.
Yes,
valuation.
Yeah, so multiples have been dropping in recent months. That does provide a very good entry point for new money. And that means that the long-term relationships we've been building with institutions and intermediaries accessing the private wealth market are quite tempted to, or the individuals and the institutions are quite tempted to pull the trigger. So that's underpinned a very strong pipeline that we've got into the start of 2019.
You mentioned the diversity of strategies that you offer in the within your investment portfolios. Would you like to highlight one or two that are particularly strong performers, or where you see momentum and demand for investment continuing?
Yes, I've already mentioned global opportunities, and I think that does stand out as offering clients who want a core equity exposure the best ideas across Impax's idea generation, if you like. In the thematic equity range, then our water strategy has been a consistent outperformer in the 10 years since its launch back the end of 2008, early 2009. And our private equity strategy around renewable energy asset construction and asset development is also doing very well and has got great prospects for the next 5 to 10 years.
You mentioned the global opportunities, and it's been both performing and attracting assets extremely well. Is it typically investing in a larger quoted investment as opposed to some of the other funds that might be in illiquid or private companies?
I think it's been very clear over the 20 years we've been building Impax that the transition to a more sustainable global economy is affecting markets across the world in almost every sector of the economy. And that means that not just small micro cap and small cap companies are showing great signs for the future, prospects for the future, but also the mid and large cap companies that are getting into these areas around resource efficiency, clean energy supply, water treatment, etc. So global opportunities does provide good access to large cap stocks, and that's obviously great for risk management in uncertain economic times. It does have a bit of a mid cap and small cap bias though, which is where quite often value is to be had.
Yeah, it's reassuring to hear, as you've already mentioned, £12.5 billion of assets under management, and that's a large fund. The capability to deploy that without having to pay a premium to take a position is a positive, I'd say. And in terms of the growth to 12.5 billion in total, we'll talk a little bit more about Pax in a minute or two, I'm sure. But looking around the world, are there any particular continents or countries where you've seen particularly good inflows of money to manage?
Well, for the last few years, then continental Europe and North America have been the source of most of our inflows. That trend has continued into 2018, the year we've just reported on. It's actually set to continue into 2019 as well. As I was mentioning, the Pax acquisition does give us a substantial footprint now in the US on the back of about £1.5 billion under management. That's leapt up to nearly £5 billion. And so that gives us a very strong calling card to try to build further relationships in the US wealth market as well as the institutional market. So very excited about the prospects in the medium term for flows from the US. But continental Europe does continue to be the source of our largest fraction of new assets through particularly distribution partners. One thing that it's worth noting actually is that we do feel as though our brand and our outreach programme are successfully penetrating the UK market once again. And so on the back of the St James's Place mandate and on the evidence from our investment trust, Impax Environmental Markets PLC, where the discount has effectively disappeared and as a premium has emerged, that the UK wealth and institutional market is starting to take serious interest again in what Impax is offering.
I'm sure we'll hear a bit more detail from Charlie shortly about the integration process with Pax. But have you had to change much in terms of the offering that they're presenting at the moment, or is that going to be a more gradual reconstruction of their portfolio that's available to investors over there?
Well, the Pax Wealth Management business became available for sale, if you like, at the end of 2016 as a result of the family owner's decision to sell. The business had been running very successfully. It was very well managed. And so when we were able to close the merger in January 2018, there was no obvious need to change anything. So as you've noted, we have been integrating, but that's integration of two strong and successful firms rather than an integration based on the need to repair damage. So over time, we are going to be seeing what else we could do to enhance the client outreach and inflows on the Pax World Funds platform and to see whether some of the strategies that they run from Portsmouth, New Hampshire will be of interest to European institutional clients. That's the primary focus for the joint planning, rather than the need to cut costs or to change anything.
Mm-hmm. And in terms of these results, which are very transparent, there has been a small decline in the assets that Pax are managing relative to the year before. Is that just a function of one or two specific funds not being in the right area for the marketplace or suffering performance? And after that, could you just comment about the earn-out process regarding the takeover, which I believe is related to the total assets under management by Pax in a future period?
Yes, so the backdrop here is that in 2018 markets have become fragile and flows for US mutual funds have turned negative
across the
board.
Yeah.
Exactly.
Mm-hmm.
So although Pax World Funds, of which there are now 12, there have been 3 or 4 that have been attracting quite significant net inflows. There have been a number that have seen outflows as well. Then the netting off of those two has been a slightly net negative result, which is actually better relative to most of the peers as far as we can see. In terms of the contingent consideration, as it's called, so the earn-out, then that will be measured. The primary measurement period is 2020, and if the assets under management of that unit rise from today's $4.5 billion to above $5.5 billion, then contingent consideration, as it's referred to, will be payable in early 2021. It's too early to call how much that will be. We don't want to
require a 20% gain in that period, which...
Yes, exactly. So that's entirely possible.
Be very. I'm sure you'd be delighted to have that pay-away to come on that basis.
Well, given the pricing of that contingent consideration, that's absolutely right. That if we pay our contingent consideration element, then generally speaking, we are happy because the multiple on that is less than the multiple of the original transaction and the original consideration.
Mm-hmm. And then lastly, and again on Pax, in terms of putting two organisations together, any change in personnel at all, and presumably this is a considerable benefit for the integration that you have as organisations known each other for a long time.
Yes, we've known each other and worked together for 10 years in the context of jointly developing and running a mutual fund in the environmental sector for US retail investors. The integration is based on very exciting growth plans. Both organisations have been expanding their client outreach and their assets under management over several years, and so the integration is really looking for synergies against a backdrop of growth. So there have not been, and we don't anticipate any redundancies, but we'll hopefully be able to slow down the rate of new hires in the context of an expanding asset base.
Right, good to see you again, Charlie. Very nice set of numbers. Perhaps you want to just start and pull out the key highlights for that you're pleased with and what you think investors should be looking at.
Great, thanks Andy. Yes, we're delighted with these sets of results. They reflect very strong growth of the business and also the acquisition of Impax New Hampshire that Ian's already talked to. If we look at revenue, that's doubled over the course of the year from 32 million to 66 million. And that's driven by both organic growth in the sense that our listed equity business has seen a 10 million increase in revenues arising from inflows, market performance, and also annualisation of previous year inflows. The private equity business has benefited from some non-recurring items, which are very favourable. The private equity fund, our second private equity fund, returned some capital to investors when they made some successful exits, and that has produced carried interest of 5 million income. And most importantly of all, the Impax New Hampshire business itself, which we include for 8.5 months for the first time this year, included 16 million of revenue. So all in all, very, very strong revenue performance.
Mm-hmm. And how is that revenue moving through to the bottom line, as it were, in terms of earnings, dividends, the things that shareholders like reading about?
Well, very well is the answer to that. The cost base for Impax is shown on the right of slide 17, and we there provide some transparency for both the Impax London and Impax New Hampshire side, and staff and non-staff costs. Unsurprisingly, being a people business, the staff is the main component. So we have seen some increases within the London business as we've scaled the business up to support the growth, 15 headcount higher during the year. We also pay profit-related remuneration. So this rises and falls with profitability, and as the profits are going up this year, then that has increased. And of course, we've brought in the New Hampshire business, which is a new cost for us, 8.5 months worth of cost. Those looking closely at the slide will see that the other non-staff costs look quite high compared to the Impax London as a share of the cost, and there's a very good reason for that, which they have a slightly different business model to ours in terms of how they bill their clients. The New Hampshire model works on what they call a unified fee basis, whereby they charge a slightly higher fee to their clients, but as a result incur costs which in London we would traditionally see the funds paying. These are things like administrative costs, etc. So as a result, you see a higher cost base in the non-staff category for New Hampshire.
And presumably that is an American way rather than a simple Pax way of structuring the fees.
Yes, the mutual
So
fund
it's not
industry,
likely to change going forward or anything like that.
That's correct.
Right.
We don't see any pressure for that to occur in any other type of our business, although it's impossible to say exactly the direction of travel of that. This does mean that the operating margin contribution from New Hampshire is lower than for the London business. Overall, however, the profits have more than doubled to 20 million, which does reflect some of the operational gearing within the business, and at a operating margin of 30%.
And that's a consolidated group margin.
Correct. That's right.
Very good. Yeah.
I mean, looking forwards in terms of what that means on a run rate basis, by which I mean we strip out the non-recurring revenues, which are in FY18, but annualise the business units. So that's a full 12 months of New Hampshire, and to give full year effect to all of the inflows. We're now running at 70 million of annualised income, and that is producing a profit margin of around 25%. Which, so you have to remember, this is a blend of the higher margin London business and the lower margin New Hampshire business. We expect, as Ian's already mentioned, high demand to continue for all of our products, and with market conditions willing, we would expect to see revenues to continue to grow through inflows and market performance, and we'll be continuing to ensure that we can support that business by adding to costs as and where necessary.
And
So,
hopefully margins to also grow
exactly.
with the leverage effect. I would
yes,
imagine.
so as we proved in the past, we would expect revenues to go faster than costs, and the margin to expand as a result.
Good, very encouraging.
So in terms of the other part of your question, Andy, on earnings and dividends, slide 19 sets that out quite nicely. And we can see on the left that the earnings per share, diluted earnings per share, has grown very strongly. First and foremost, driven by the increase in the Impax London business, where the earnings have resulted in pretty much a doubling directly just even from that component. Secondly, New Hampshire, the 8.5 months of contribution is also very favourable, and we've now started paying debt interest. So there's a small amount of debt interest as part of that chart as well. Finally, as part of the acquisition, 2.5 million shares were issued to partly pay for the Impax New Hampshire business. That was only 2% dilution at the time, so only a small proportion, but you do see that as a result there is a small dilutive impact on the earnings per share. Overall, however, the rise up to 12.5 pence per share is a very strong result for the period. And armed with that, the board has proposed a 3 pence final dividend, taking the full year dividend to 4.1 pence per share, a 41% increase on last year, which is 3 times covered from earnings. That in addition to a 2.6 pence per share special dividend, which Ian has already described.
And you mentioned that this is a progressive dividend policy. Is there likely to be any rethink as you look at other growth opportunities, or whether to invest more in the business given the expanded opportunity?
Sure, yes, thank you, Andy. As you can see on the graph, the progressive policy has been stuck to since we initiated in 2008. The position we're now in is that the business continues to be very cash generative, which I'll show in one moment. So the opportunity is there for us to reflect on the optimal dividend policy. And we made a comment in the report and accounts to say that we'll come back to this in a year from now, but there is a potential to review that policy, noting the strong cash generation of the business.
And the 3 times cover. Yeah.
Absolutely.
Thank you. Yeah.
So moving on to the balance sheet and what I just referred to, the balance sheet has grown over the course of the year, primarily as a result of the Pax acquisition. We can see that The net assets have increased by 20 million. That is a combination of predominantly retained earnings, but also the modest issuance of share capital that I described earlier. And that has enabled us to fund the acquisition of Impax New Hampshire, where we can see goodwill and intangibles now on the balance sheet. You can also see currently 10 million of debt, which is modest in the scheme of the net assets of the firm. You'll also note that Impax New Hampshire itself is actually very balance sheet light. That's basically the balance sheet. In terms of cash movements, the way we look at cash is shown on the right, and the main effect we see here is the very strong cash generation. If we look at the starting cash level of 20 million, the business has generated 23 million of after-tax cash flow. When after having paid dividends, the other major effect is, unsurprisingly, the acquisition itself. So this chart shows 17.6 million of borrowing from the bank, the acquisition of Impax New Hampshire, which was mostly paid for in cash, and then repayment of debt. When we drew down debt, we had two types of debt: fixed debt and a revolving credit facility, and the revolving credit facility has been entirely repaid. In terms of that 24.6 million number and rationalising, is that a good number or a bad number, too high, too low? The diagram on page 21 shows that we regard that as exactly the right number for this stage of our business development. We first will have to reflect that we are a financial services firm with capital requirements, so take a risk buffer as an initial deduction from the 24.6.
Might I just inquire how
Sure.
the acquisition of Pax has adjusted that risk buffer, or in the eyes of presumably the FCA in the UK sense?
So to answer that question technically, the FCA does not look at that business directly because it is not regulated by the FCA. However, when we look at it on a consolidated basis, then we do need to factor something in, and the increase is modest. I think from recollections around 1 million.
Right, thank you.
So finalising my comments there, we then look at the cash and earmark it for upcoming requirements. So near-term working capital requires nearly 8 million, and then we've also put money aside for near-term bank debt repayment and the final dividend. So the resulting, what we call on here, unallocated cash of 1 million, we have to remember is also supplemented by the revolving credit facility. So we have a 13 million debt facility which we can use potentially to pay deferred consideration, as Ian's described, or for the general corporate purposes of the firm.
Flexibility. Yeah.
Absolutely.
Yeah. Okay.
The final thing I was going to note is on slide 22. It's quite a busy slide. I'll only point out a couple of things on here. Firstly, just to re-emphasise, on the top left, if we look at the Impax shares in issue, 2.7 million shares issued to the Pax vendors is modest in the scheme of the total equity. And the other thing I'll note is that on the bottom right, the pie chart showing the ownership, BNP Paribas Investment Partners, a major distribution partner of ours, owns 25% of the shares. Employees, very important to have them aligned to the corporate interest, own 30%, resulting in a free float of 46%.
Yeah, well, an encouraging note on which to finish. As the market cap has grown, so has trading and liquidity in the shares, as is reflected in the available free float as well. So congratulations and thank you, Charlie.
Thank you.
Right, and perhaps we might now return to Ian for a concluding summary of where the group is at and what your ambitions are for the future. And of course, we very quickly forget that Impax has now been around for 20 years, and you've been running it for that period. But that in itself must be a very strong platform and track record to go out and again promote the company further.
Yes, I think in the context of an asset management industry that's increasingly splitting between, on the one hand, high demand for low-cost passive products, and on the other hand, specialist differentiated investment ideas run by boutiques, then Impax's offering does fit very neatly into that second category. Our investment philosophy around the transition to a more sustainable global economy has very strong, compelling drivers with a 10-year, 20-year, probably even a 50-year view, given the expected population dynamics over the rest of the century.
Feeding 9 billion people, etc. Yeah.
Well, it's 7.6 at the moment. It may well get to 11 point something by the end of the century, which is a pretty scary prospect. So in that context, the investment ideas that we have deep expertise in analysing and selecting from are continuing to grow. We are committed to running an institutional quality investment process and keeping our investment teams and the rest of the staff aligned with external shareholders, so management continues to own 30% of the business. And at a time when investment is increasingly looking for new ideas, access to markets that are perhaps growing more rapidly than the rest of the economy.
Returns. Yeah.
Yep, then our medium to long-term prospects remain excellent.
That's good to hear. And in terms of your client base, has that been very loyal to you through that 20-year period, and how spread is it globally?
Well, our client base has obviously grown considerably over that 20-year time period. I think we've been very fortunate in having very high levels of client retention and also repeat business from existing clients. As set out in our slide deck, a majority of our clients do come from continental Europe, although with the Pax acquisition, the US is quite material now as well. And so looking to the future, I think we will very clearly focus on strong client service and further outreach in those two major geographies while not ignoring the UK. So the other area that we've not mentioned is Asia. We've had an office in Hong Kong now for 11 years, very strong and capable team of largely Chinese-speaking analysts, and maybe sort of over a 5 to 15-year time frame, there's no reason why Asia couldn't feature much more prominently in our offering, both in terms of the investment ideas we're looking for and also the clients.
Sources of capital, yeah. And again, using that crystal ball, you mentioned earlier on that the US is now a sizable proportion of that 12.5 billion under management. Presumably it's quite conceivable, given the scale of the economy there and the amount of capital, that the US will become the largest proportion of your sources of asset under management.
It could do, yes. I think on average, US exposure to this transition to a more sustainable economy is low relative to Europe. However, there's no signs that continental European institutions and private wealth managers are slowing down in their appetite for more product and exposure to the space. So I don't think we need to call which one's going to be largest. We're just trying to...
You're well placed to cover either.
Yeah, exactly.
Eventuality, that makes sense. And then the very last point, which we've obviously seen the benefits of it in the recent years, is the scalability of the business to continue to attract more money to manage with associated fees, but the costs and the amount of human resource required to manage that will not be growing in tandem, but hopefully at a lower rate with margin implications.
Yes, that's right. So we've very deliberately focused our business on a small number of scalable strategies where we can deploy the same resource, front office, middle office, back office, to manage more and more money within reason. And so we're hoping that that should feed through to expanding operating margins over the next few years.
Great. Well, we continue to wish you more luck in growing those assets. Thank you, Ian. Thank you, Charlie. And I would point out to any of you interested that the full slide deck, you will have seen the relevant slides during this presentation, is available on the Impax Asset Management website. Thank you, gentlemen.
Thank you.